when to sell stocks. We recently did a piece on how to buy stocks, and the more important question is when to sell stocks. The problem that most newbies face when it comes to not knowing whether they should sell a stock is when they enter a position someone else convinced them to open, and then that person isn't around to tell them when to sell it. So usually the process that goes into that is these newbie investors will come across a quote-unquote stock tip and then ask, is the person qualified giving this, and then trust them and enter the position. The answer is it doesn't matter if they're qualified because everyone on Wall Street is, yet 95% of professional money managers can't beat a benchmark. You'll worry a whole lot less about stock price declines and whether or not you should sell a stock if you enter that position based on your own convictions. That's the first important takeaway here. Don't let other people convince you to invest in a stock. Make that decision yourself, and then you'll be able to tolerate price declines a whole lot more. Experience will certainly help. So over time, you learn how to manage your own emotions, and looking to the experts for an answer is not a good idea, especially on social media. The old adage, why does someone drive a Bentley to their financial advisor's office to take advice from someone who rode the train into work? And indeed, a lot of these people on social media talking about how big their portfolios are riding the train into work for their 9-to-5s that probably don't have anything to do with the financial sector. Now, the answer here on when to sell stocks, it's to try not to sell stocks at all. So when you purchase stocks, try to minimize the likelihood that you'll want to sell them. What do we mean by that? Well, if you're purchasing a stock for all the right reasons and it's a quality company, the likelihood of you wanting to sell it diminishes a lot. You can ask the question, what makes us want to sell stocks? Well, usually it's prices rising and falling very quickly. The ideal cadence for a good investment is slow, steady growth over long periods of time. For intrinsic value, that's the real value of a company to change a lot. You need a lot of time for that. It doesn't change that quickly, despite what all the pundits out there will tell you, and they're promoting their sacred cow that suddenly the market's realizing the value of my stock. No, they're not. The stock price is moving, not the company's intrinsic value. That's why we invest in companies, not stocks. And you'll see these meme stock types driving prices up. That does nobody any favors. And volatility is a bad thing, and we dislike it even when that's going in the right direction. So if a stock we're holding triples in several months, that's not a good thing, and that's usually relatively easy to spot whether it's hype or not, because that share price movement will usually affect a group of stocks with similar characteristics. Examples would be AI hype or gene editing stocks. Now, when you don't sell and it's going up like that, expect to watch those gains evaporate, and a lot of investors can't handle that, and that's where experience comes into play, and you don't let your emotions get the best of you. Say, why should you care about short-term price movements anyway? You're in it for the long term, the long horizon investment where that intrinsic value takes time to mature. And of course, volatility goes both ways. Now, if you choose to play stupid games, you're going to win stupid prizes. We see people saying things like, well, I know this is a speculative meme stock mess, but I'm just going to play it safe and just trade this one. You're never going to become some big swinging dick trader. We've done pieces on that. It's proven most people nearly all people that get involved in jumping in and out of the market lose money. You see people say things like, well, I play it safe by setting stop losses on each trade. That's not a good idea, because essentially you're speculating on the price movements of a stock when you should be investing in a company. And when that company goes down, you're getting the same asset at a discount. You should be buying, not selling. And you'll hear people say things like, if it's the next Microsoft, all I need is a little. It's certainly that makes sense. But what they'll then say is, well, I'm just going to invest money I'm willing to lose. Well, if you're going to do that, then just go to a casino. And what they're essentially doing there is they're going into a casino with $20 in their pocket. They're not investing at all. They're speculating. What this person lacks is conviction. They should make a decision. Either this is a great company to invest in or it isn't. Binary outcome. But they're saying, well, you know what? I don't want to just I don't want to make a real decision here, so I'm just going to put a little money on it in case I was wrong. You need to make decisions with convictions. Now, how do you know when to sell stocks? Well, invest in stocks that you have a very high conviction in and state that. So we're lucky here at Nanalyze. We do that all the time. That's our job. So when we enter into a new stock, there's research pieces we've published that explain why we're doing that. When we look to exit, we take our time. We publish research pieces around why we're thinking about exiting a particular company. We move very slowly. Stop looking at the market every 7 seconds. We check in with firms once a year. And honestly, I think that's one of the best rules that we came up with because it keeps us from analysis paralysis, where we're analyzing all this quarterly noise too much. So you can set your own rules as to when you'll exit any particular asset. We have rules for 2 unique scenarios. We'll need to do the same thing: when to sell losers and when to sell winners. And each of these rules will depend on the type of portfolio strategy you've adopted. So let's talk a little bit more about that. Here's a look at a 2x2 I put together around the types of investments that we make, or the 2 types of portfolios we have, and whether we're selling losers or winners. So dividend growth investing, that's really simple. We only ever sell a dividend growth company if it stops growing their dividend, and we know that when the company confirms it. And then what we'll do is we'll use reverse dollar cost averaging, so we'll sell over a series of trades, if you will, over a matter of days and exit that position. We also may plan to sell a dividend growth winner. You say, we never sell winners, and that's exactly right. We're actually hold that portfolio, and when that income starts to become something that you can live off of, sure, you may rebalance your portfolio if a stock starts to grow too much and take some of those gains as a bonus, or possibly do some sector rebalancing. But our plan is to, once we purchase a dividend growth investing stock, never to sell it. We just want the income from that. And of course, buying the best quality companies means you won't often be selling them. Now, tech investing, that's a little bit different. And we say here the decision to sell a tech stock should ideally be independent of performance. Now, of course, the exception is the aforementioned hype cycles, and that's also quite rare. But there will be situations where you'll have lost most of your money, and that's a difficult situation to be in, because then it starts to tempt you to gamble with what little is left in your position. And tech stocks are a volatile domain, so it's not uncommon for you to be down 40, 50, 60% on a particular position. So you need to establish before you even invest in a tech stock when you'll sell it. These can be at an individual company level, or you can create broader rules as we've done here. When growth stalls. Now, this is difficult. I've used the COVID example here. So let's say in 2018, you had a tech company that saw stalling growth. They say next year growth's going to resume in 2019. So you've already had 1 year of stalled growth. The next year is stalled, okay? They say next year it's going to resume. Well, next year is COVID. And then, of course, the year after that is COVID. And then the next year they say, all right, now we're back on track. So what you've been doing here is you've been holding a no-growth stock for 5 years. We've seen examples of this. Not much of a growth investor if you're holding stocks that don't grow, right? So growth stalling, that's a difficult one to figure out. But what you need to do there is set rules on a particular company, what you find acceptable growth to be, and then stick to those rules. The other reason that we'll sell of the 3 would be if our thesis changes. So this is, of course, very difficult to gauge, but some examples here. Teradyne skating to where the industrial robotics puck will be. So they made some acquisitions. They wanted to become a player in industrial robotics, and that never really transpired over time. I looked at their most recent earnings deck, and they acknowledge as much. So that's a firm that we're exiting in favor of a company that's actually skating to where the puck will be. Then you have Proto Labs. They were beaten by Xometry based on their business model of purchasing hardware versus Xometry taking a software approach. But then both firms were blindsided by what appears to be a flawed business model in the whole distributing manufacturing thesis. We've written extensively about this, but these are good examples of a thesis changing over time. Use annual checkups, as we said, to avoid analysis paralysis. These sorts of changes where your entire thesis changes, they're going to become more obvious if you only look at progress annually. That makes it a whole lot easier. Then we have our overweight rule that says this actually goes against this idea of letting your winners run and cutting your losers. Now, as we said, we cut losers and winners when the thesis changes or growth stalls. Just because we're selling a stock doesn't mean we're selling one we're at a loss on. We may have gains on that, but the growth just isn't there or the thesis has changed. Now, we set a maximum weighting rule to trim our runners, and you can adjust this rule to match your risk tolerance. We start trimming positions when they breach 11%, and we'll trim them back down to 10%. So in our tech stock portfolio, we're holding 37 stocks. If one exceeds 11% total weighting, we'll trim that back down to 10. We'll sell very slowly. Sometimes we'll sell stock every day for months, and that's just how slowly we move to exit a position. That really lets those winners run. The proceeds from these winners, these will cover your inevitable losers and also fuel the green shoots of tomorrow's disruption. Now, just to conclude, I wanted to tell a quick story on this picture of a blackboard with equations. There was recently a quote-unquote trader on Twitter who had put up a picture of equations that he had written on a piece of paper and said, unless you know calculus and advanced math, you'll never become a good trader like me. And somebody that actually knew math took a look at it. It was all a bunch of BS, and everybody's making fun of this guy. So be very, very wary of everybody out there who's trying to sell you this idea that you can become a trader. You can't. To conclude here, sometimes the definitions of when to sell stocks will be hazy. The examples we gave, growth, stalling, and thesis changing, are reasons we sell stocks. Come up with your own reasons. And it's about time in the market, not timing the market. So you want to be jumping in and out as little as possible, which means no setting stop losses. If you're serious about investing in a stock, you find it compelling, when the stock price falls, buy more of it, unless your thesis changes, and that takes time. People who use stop losses are speculating on short-term price movements. Selling with conviction is about coming up with rules and sticking to them, which is what we do here at Nanalyze. Now, I've put up another video here on how to buy stocks. Before you watch that, please click the Nanalyze logo on the right, subscribe to our channel. Thanks for taking the time to watch this today.